Hey everyone, welcome back to Corporate Decoder, the place where we unpack the nitty-gritty of company reports and tell you what it all means. Today we've got a look at the latest filing from Fidelity SALEM Street Trust their shareholder report for the period ending the 31st of August 2025. And let me tell you, it is packed with numbers and details that tell quite a story about how these funds are performing. Before we dive in, if you like getting these kind of straight to the point corporate insights, make sure you are subscribed and hit that notification bell. Also, we have a fantastic community Discord linked in the description below where you can connect with other finance enthusiasts and get even more exclusive content. This report on Form N-CSR is a big one covering several different funds, but we're going to zero in on the financial story to see what is really going on. We'll be looking at their costs, how the funds performed, what affected that performance, and what exactly they're investing in. It is a lot of information, but we'll break it down so it is easy to understand. So what we're looking at is an annual shareholder report as of the 31st of August 2025. This isn't just one fund though, it is a whole family including the Fidelity Sustainable Low Duration Bond Fund, the Fidelity Advisors Sustainable Low Duration Bond Fund Class Z, and a few others. It's a deep dive into their bond funds primarily. First up, let's talk about costs. Nobody likes paying high fees, and this report breaks it down for us. For a hypothetical $10,000 investment in the Fidelity Sustainable Low Duration Bond Fund, the cost paid was $26. That is a 0.25% of the investment. It sounds small, but over time these costs can really add up. For the Fidelity Advisor Sustainable Low Duration Bond Fund Class Z, the cost was even lower at just $21 or 0.20%. Lower costs generally mean more of your money is working for you, not just disappearing into fees. Now for the juicy part, what affected the fund's performance. For the 12 months ending the 31st of August 2025, US taxable investment grade bonds did pretty well. They navigated some uncertainty related to tariffs, and a resilient economy helped them along. Plus, the expectation of interest rate cuts by the US Federal Reserve in the latter half of 2025 gave them a boost. This is where the fund's strategy comes into play. Holding short-term debt in high-quality companies helped performance compared to the overall US Treasury benchmark, specifically debt from financial institutions like banks and industrial firms, especially those in consumer cyclical and non-cyclical areas, added a good chunk of value. It means they picked good companies that did well. Interestingly, they also had non-benchmark exposure to asset-backed securities, mainly car loan debt. This also contributed meaningfully to their performance. Think of it as diversifying into less traditional but profitable areas. However, it wasn't all good news. Their positioning on the yield curve, the range of maturities they held, detracted from their relative performance. This basically means they might have been holding bonds that didn't benefit as much from the expected interest rate changes. And that small allocation to cash also acted as a drag because cash doesn't earn much compared to investments. Looking at how the fund's investments changed over the year, we see a shift. Corporates dropped from about 60% of assets to around 48%. On the flip side, their exposure to US treasuries increased slightly from 26% to about 30%. They also increased their stake in asset-backed securities from 11% to 19%. This suggests a move towards safer assets like treasuries and a continued bet on asset-backed products. They're also applying environmental, social, and governance ratings, which might affect their performance, but that is a strategy choice. Let's talk about how the fund performed since it started. For an initial investment of $10,000 in Fidelity Sustainable Low Duration Bond Fund, it grew to $10,001 by 2023, then $10,404 by 2024, and finally $11,006 by 2025. That is a decent climb, outpacing both the Bloomberg US Treasury Bill Index and the Bloomberg US Aggregate Bond Index. The one-year return for the fund was 4.81%, and life of fund return was 4.31%, which is pretty solid in this market. Let's peek at some key fund statistics. The fund size is about $47 million with 322 holdings. Portfolio turnover was 58%, which indicates they are actively managing the fund. So what did the fund actually invest in? US government and agency obligations make up a hefty 29.5% of the net assets. Then we see AAA rated securities at 17.8%, followed closely by a rated at 24.9% and BBB rated at 19.2%. This shows a clear focus on high quality investments, which is typical for a low duration bond fund. Looking at the top holdings, US Treasury bills are the largest component at 21.6%, followed by US Treasury notes at 7.9%. Big banks like JP Morgan Chase and Bank of America also feature prominently, showing their reliance on major financial institutions for exposure. Importantly, the top 10 holdings make up 40.4% of the fund, which gives us a good idea of where the money is concentrated. Now let's switch gears to the Fidelity Advisors Sustainable Low Duration Bond Fund class. This seems to be an institutional share class. What were your fund costs for the last year? For a hypothetical $10,000 investment, the cost was $21 or 0.20%. That is even lower than the previous fund. That is excellent. The performance drivers were virtually identical to the previous fund. US taxable investment grade bonds navigated tariff uncertainty but were buoyed by stable consumer inflation. The strategy of holding short-term debt in high-quality corporations contributed to performance versus the all-US Treasury benchmark. Debt holdings among financial institutions, especially banks and industrial firms, were key. Asset-backed securities like car loan debt also contributed. Looking at cumulative performance for this class from the 13th of April 2022 to the 31st of August 2025, a $10,000 investment grew to $11,019. It performed slightly better than the public benchmark indices. The one-year return was 4.86% and life of fund return was 4.36%. This again shows solid, if not spectacular, performance. The fund statistics are identical here, which makes sense as they are likely managed similarly. Fund size 47 million, number of holdings 322, total advisory fee $74,586, and portfolio turnover 58%. This is the same pie chart, just with a different share class. Next, let's examine what affected the fund's performance for its period. The narrative remains consistent with the previous fund. This period's performance was solidly advanced by US taxable investment grade bonds. They navigated tariff-related uncertainty, which was present since late 2024, but they were buoyed by stable consumer inflation, a resilient economy, and the expectation of policy interest rate cuts. Now let's shift focus to the Fidelity Sustainable Core Plus Bond Fund. This fund is a bit larger at $47.7 million in size, with more holdings at $699. The portfolio turnover is significantly higher at 201%. This suggests a more active management style and potentially more trading. What affected the fund's performance this period? The report highlights that US taxable investment grade bonds saw a solid advance. They navigated tariff-related uncertainty and were buoyed by stable consumer inflation and the expectation of policy interest rate cuts. Against this backdrop, an allocation to high-yield bonds contributed positively to its outperformance of the Bloomberg US Aggregate Bond Index. This means they weren't just sticking to the safest bonds, they were willing to take on a bit more risk for better returns. Security selection also added value. Their holdings in the corporate segment were notable, particularly among financials like REITs and banks. An overweight in collateralized loan obligations also helped. On the flip side, their underweights in mortgage, backed securities and US Treasuries buoyed relative performance. This indicates a strategic decision to avoid areas that lagged the benchmark. Looking at the fund's investments, US government and US government agency obligations form the largest piece at 55.1%. Corporate bonds are second at 33%. This is a much heavier tilt towards government debt compared to the other funds we've seen. Then we have US Treasury obligations at 29.5% and asset-backed securities at 19%. Geographically, the fund is heavily concentrated in the United States at 85.8%. Canada comes in second at 4.2%. This is typical for many bond funds. Top holdings are dominated by US Treasury bills, and notes making up almost 30% of the fund. Financial institutions like JP Morgan Chase and Bank of America are present, but in smaller percentages compared to the previous funds. Now, we're diving into the Fidelity Short-Term Bond Index Fund. This is an index fund, so its goal is to mirror a specific market index. The fund costs for the last year for a hypothetical $10,000 investment were very low, just $3 or 0.03%. That is incredibly cheap operating cost-wise. What affected the fund's performance this period? The report states that US taxable investment grade bonds were driven early on by the Federal Reserve's pivot to cutting interest rates from September through December 2024, and late in the period by expectations that the central bank would resume rate cuts in September 2025. This is a key point for a short-term bond fund, as their performance is heavily tied to interest rate movements. Asset allocation data shows a massive 69.8% in US government and US government agency obligations. This is very high even for an index fund focused on government bonds. Corporate bonds make up 28.3%. This large allocation to government debt means it is likely tracking a government bond index. Top holdings are dominated by US Treasury notes at 69.5%. This further confirms its heavy focus on US Treasuries. The rest of the top holdings are also US Treasury bills and notes, indicating a very narrow investment focus. The strategy here is straightforward, mirroring an index and keeping costs extremely low. Next, let's look at the Fidelity Series Sustainable Investment Grade Bond Fund. This fund had zero fund costs for the last year, which is unusual and worth noting. A 0% cost means essentially no expense on that $10,000 hypothetical investment. What affected the fund's performance this period? Similar to the other funds, US taxable investment grade bonds posted a solid advance. They navigated tariff-related uncertainty but were buoyed by stable consumer inflation, a resilient economy, and the expectation of policy interest rate cuts. The investment breakdown is interesting. US government and US government agency obligations are again dominant at 69.3%. AAA rated securities are at 15.6% and are rated at 24.9%. Noticeably, there is a significant portion in short-term investments and net other assets liabilities at 27%. This is a very high allocation to short term holdings, which can indicate a strategy focused on capital preservation and liquidity. Key facts about the fund show a fund size of $11.7 million and only 177 holdings. This is a much smaller and more concentrated portfolio than some of the others we've seen. The total advisory fee is actually $0, which aligns with the previous point about zero fund costs. Portfolio turnover is high though, at 235%. The performance over 10 years for the Fidelity Conservative Income Bond Fund shows consistent growth starting from $10,000 to $12,685. Its one-year return is 4.82%, the 5-year is 3.11%, and the 10-year is 2.41%. This tells us it has had steady, if not spectacular, growth over the long term. Let's pivot to the Fidelity SI Investment Grade Securitized Fund. This is an interesting one focusing specifically on asset-backed securities. The cost for a $10,000 investment was $31, which is 0.31%. Not the cheapest, but competitive. What affected the fund's performance this period? The key driver appears to be US taxable investment grade bonds continuing their solid advance. However, an underweight to MBS, specifically 15-year mortgages, detracted from performance versus the Bloomberg US Securitized Index. An underweight in Ginnie Mae securities also hurt. Digging into the asset allocation, we see a massive 90.9% in US government agency mortgage securities. That is extremely concentrated. CMOs and other mortgage-related securities make up another 24.8%. This fund is heavily invested in mortgage-related assets, which aligns with its name. What did the fund invest in? US government and US government agency obligations are a whopping 94.3%. AAA rated securities are 9.3% and AA rated are 0.8%. The rest is not rated at 17.9%. This isn't typical for an investment grade fund, as not rated usually suggests lower quality. Let's look at the top holdings, and this is where things get really concentrated. Fannie Mae Mortgage Pass through certificates are 33.9% and Ginnie Mae 2 Pool at 22%. This fund is really heavily concentrated in Fannie Mae and Ginnie Mae securities. This explains the name and the strategy, but also highlights a significant concentration risk. Now we're looking at the Fidelity Conservative Income Bond Fund. For a $10,000 investment, the cost was $26 or 0.25%. The performance drivers are consistent with the theme of US taxable investment grade bonds advancing. They navigated uncertainty but were buoyed by stable inflation and the expectation of Fed rate cuts. Asset allocation shows a notable 27.7% in short-term investments and net other assets liabilities. This is a large allocation to cash or cash equivalents, suggesting a low-risk strategy. They also hold corporate bonds at 38.2% and US Treasury obligations at 18%. The quality diversification shows a significant chunk is rated at 23.8%, with some BBB rated at 9.7%. Top holdings are dominated by US Treasury bills and notes at 14.2% and 3.8% respectively. What is interesting are the next holdings. Mitsubishi UFJ Trust and Banking Corp and Mizuho Bank Ltd, both foreign banks, are in the top 10, which is a bit unusual for a fund focused on conservative income bonds and heavily weighted in US Treasuries. Finally, let's examine the Fidelity Series Corporate Bond Fund. For a $10,000 investment, the cost was $0 a year. That is essentially free management, which is quite impressive. What affected the fund's performance? The report points to solid advances in US taxable investment grade bonds. Security selection contributed to outperformance versus the Bloomberg US Credit Bond Index. Bond picks in the industrial sector, especially Warner Brothers Discovery and Boeing, were strong performers. Financial issuers like banks and insurance companies also helped. The asset allocation is quite clear here. Corporate bonds are the dominant investment at 83.2%. US Treasury obligations are a modest 10.1%. This fund is heavily focused on corporate debt. Looking at quality diversification, we see a significant portion in BBB-rated bonds at 52.7%. While this offers a yield advantage, it also comes with higher risk than AAA or AA-rated bonds. Top holdings include US Treasury bonds at 10.1%. Then we see major corporations like Bank of America, Morgan Stanley, and JP Morgan Chase, indicating a focus on large cap corporate debt. It is interesting to see US Treasury bonds in the top holdings for a corporate bond fund. It likely serves as a diversification or liquidity tool. Alright, so what is the overall story here? We're looking at a range of bond funds from Fidelity, all reporting for the period ending the 31st of August 2025. The broader market for investment grade bonds was good. Funds focused on high quality and short-term bonds generally did well. The index funds like Fidelity Short-Term Bond Index Fund and Fidelity Sustainability Bond Index Fund stand out for their incredibly low costs, meaning more of your money is invested. The Sustainable Core Plus Bond Fund shows a willingness to take on higher yield opportunities like high yield bonds and collateralized loan obligations, which contributed to its outperformance. The Conservative Income Bond Fund appears to be playing it safe with a large allocation to short term instruments and US Treasuries. The series Corporate Bond Fund is heavily invested in corporate debt with a large portion in BBB-rated securities, indicating a focus on yield opportunities with some inherent risk. The biggest takeaway is diversification and cost. While all these funds aim for income and capital preservation, their strategies vary. The index funds are the clear winners on cost. The Sustainable Core Plus Bond Fund shows a more active and risk-tolerant approach, which paid off in this period. The Conservative Income Bond Fund sticks to safety, but its large cash position and focus on lower-rated corporate debt might be a signal of either caution or a hunt for yield. The series Corporate Bond Fund is heavily corporate-focused, which is expected, but the large allocation to BBB-rated debt means investors should be aware of the potential downsides. Crucially, the performance narrative for most of these funds highlights the resilience of the US economy and the anticipation of Federal Reserve rate cuts. This has generally been a positive backdrop for bond investments. However, the report also points to detractions from performance due to yield curve positioning and smaller allocations to cash or other areas. This underlines the constant balancing act fund managers perform. What is your take on these Fidelity funds and their performance? Are you happy with the lowest expense ratios, or do you prefer funds that take on a bit more risk for potentially higher returns? Let me know your thoughts in the comments below. If you found this breakdown valuable, please give it a thumbs up and subscribe for more deep dives into the world of corporate finance and investments. We're building a great community on Discord, so make sure to join us there too. Thanks for watching, and we'll see you in the next episode. Hey everyone, welcome back to Corporate Decoder, the place where we unpack the nitty-gritty of company reports and tell you what it all means. In this video, we're diving deep into a substantial SEC filing from Fidelity Salem Street Trust, their certified shareholder report for the period ending the 31st of August 2025. And let me tell you, it is a treasure trove of financial data from several of their bond funds, a real look under the hood of how these investments are really doing. If you appreciate getting straight insights from corporate documents, make sure you are subscribed and hit that notification bell. We also have a fantastic community Discord linked in the description below where you can connect with other finance enthusiasts and get even more exclusive content. This report covers a range of funds including the Fidelity Conservative Income Bond Fund, the Fidelity SI Investment Grade Securitized Fund, the Fidelity SI Sustainable Low Duration Bond Fund, not to mention the Fidelity Series Corporate Bond Fund Fidelity Series Sustainable Investment Grade Bond Fund, Short-Term Bond Index Fund Sustainability, Bond Index Fund, and others. It is a comprehensive review of their bond fund performance. First, let's talk about the costs associated with these funds. For a hypothetical $10,000 investment in the Fidelity Sustainable Low Duration Bond Fund, the costs paid were $26, which comes out to 0.25% of the investment. That sounds pretty small, but over time these costs can really eat into your returns. Now for the Fidelity Advisor Sustainable Low Duration Bond Fund class, things were even cheaper. The cost was $21 or 0.20%. That is a real saving. So what really moved the needle for these funds over the past 12 months ending the 31st of August 2025? The report indicates that US taxable investment grade bonds generally did well. They managed to navigate tariff-related uncertainties that popped up since late 2024, but were ultimately supported by consumer inflation that remained relatively stable, a resilient economy, and the growing expectation of interest rate cuts by the US Federal Reserve in the second half of 2025. This is where the fund's specific strategy comes into play. For the Fidelity Sustainable Low Duration Bond Fund, its approach of holding short-term debt in high-quality corporations was a performance booster when compared to the benchmark, which was an all US Treasury index for this fiscal year. The report mentions that debt holdings within financial institutions, particularly banks and industrial firms, especially those in consumer cyclical and consumer non-cyclical segments, added notable value. This suggests smart picking of companies within these sectors. Beyond just the benchmark companies, the fund also made non-benchmark investments in asset-backed securities, and these contributed meaningfully to performance. Primarily, we're talking about car loan debt. This shows the fund managers were looking for opportunities outside of the standard indexes. However, it wasn't all smooth sailing. The report notes that the fund's positioning on the yield curve, meaning the mix of short, medium, and long-term maturity bonds they held, actually detracted from their relative performance. That means their bets on when interest rates might change didn't quite pan out as expected. A small allocation to cash also acted as a modest drag on performance too. Let's look at the shift in assets. By the 31st of August, corporates represented about 48% of the fund's assets, down from roughly 60% just a year prior. Meanwhile, their exposure to US treasuries rose from about 26% to around 30%, and that bet on asset-backed securities saw an increase from about 11% to 19% as of the 31st of August. This indicates a strategic move towards government bonds and asset-backed securities, perhaps as a defensive play given the changing rate environment. We also see a mention of FMR's environmental, social, and governance ratings process, which might impact holdings and therefore performance. Now let's check out the fund's performance over its lifetime. For an initial investment of $10,000 in the Fidelity Sustainable Low Duration Bond Fund, it grew to $10,001 in 2023, then $10,404 in 2024, and finally $11,006 by 2025. That is a decent gain. It outpaced the Bloomberg US Treasury Bill Index and the Bloomberg US Aggregate Bond Index. Its one-year return was 4.81% and its life of fund return was 4.31%. Solid performance indeed. Looking at some key fund statistics, as of the 31st of August 2025, the fund size was $47 million with 322 holdings. The total advisory fee was about $74,586, and the portfolio turnover rate was 58%. This turnover rate suggests moderate active management, meaning they're buying and selling some securities within the year, but not constantly churning the portfolio. As for what the fund invested in, about 29.5% was in US government and US government agency obligations. AAA rated securities accounted for 17.8%, are rated at 24.9%, and BBB rated at 19.2%. This shows a strong preference for high-quality debt, which is expected for a fund aiming for sustainable investment-grade bonds. Looking at the top holdings, US Treasury bills are the largest at 21.6%, followed by US Treasury notes at 7.9%. Big names like JPM, Morgan Chase, and Bank of America also appear. The top 10 holdings represent 40.4% of the fund, which is a notable but not extreme concentration. Now let's talk about the Fidelity Advisor Sustainable Low Duration Bond Fund Class Z. This is likely an institutional share class with even lower costs. The report says the cost for them was $21 or 0.20%. That is even better. The performance narrative here echoes what we saw before. US taxable investment grade bonds did well navigating uncertainties and benefiting from stable inflation and expected Fed rate cuts. The strategy of holding short-term high-quality corporate debt contributed positively. Financial institutions and industrial firms were particularly strong performers, and asset-backed securities, including car loan debt, also helped. Now let's check out the cumulative performance for this Class Z share. For an initial $10,000 investment, it grew to $11,019 by August 2025. That is slightly better than the previous share class for this fund. The average annual total returns for the one-year period were 4.86% and life of fund was 4.36%. This fund class seems to be performing well. The key fund statistics here are the same as the other share classes as expected, since they are part of the same fund. Fund size $47 million, number of holdings 322, total advisory fee $74,586, and portfolio turnover 58%. Next up, we have the Fidelity Sustainable Core Plus Bond Fund. This one is larger in terms of holdings at 699. Its portfolio turnover is much higher at 201%. This indicates a high level of active trading and management. What affected the fund's performance this period? The report details the steady advance of US taxable investment-grade bonds. But importantly, it notes that an allocation to high-yield bonds contributed to the fund's outperformance compared to the Bloomberg US Aggregate Bond Index. This is significant because it shows the fund managers were actively taking on more credit risk to generate better returns. Security selection in corporate bonds, especially financials like REITs and banks, was also a key driver. Looking at asset allocation for this fund, US government and US government agency obligations are the largest segment at 55.1%. Corporate bonds follow at 33%. This is a significant shift from the previous low-duration bond funds, which were more heavily weighted in corporates. Then we have US Treasury obligations at 29.5% and mortgage-related securities at 16.2%. This fund appears to be a blend of government corporates and mortgage-backed securities, offering broader diversification within the bond market. Geographically, the concentration in the United States is still high at 85.8%. But this fund also shows a bit more diversification, with Canada at 4.2% and the United Kingdom at 3.7%. The top holdings are dominated by US Treasury notes and bonds, making up over 38%. This suggests a significant allocation towards US Treasuries within this Core Plus strategy. Bank of America and JP Morgan Chase are also listed, but again, the Treasury holdings are paramount. Then we have the Fidelity Sustainable Core Plus Bond Fund Class Z. This is another institutional share class. Costs last year on a $10,000 investment were $37 or 0.36%. Still quite low. The performance drivers are similar to the other Core Plus strategies. US taxable investment grade bonds advanced. High-yield bonds contributed to outperformance and security selection in corporates, particularly financials like REITs and banks added value. Overweights in collateralized loan obligations and underweights in mortgage-backed securities and US Treasuries also helped. Performance was boosted by their yield curve positioning. Let's check cumulative performance for this fund from April 2022 to August 2025. A $10,000 initial investment grew to $10,308. It slightly underperformed the Bloomberg MSI US Aggregate ESG Choice Bond Index and performed slightly better than the Bloomberg US Aggregate Bond Index. The one-year return was 3.58% and life of fund was 1.95%. This shows moderate growth in a challenging market. The key fund statistics are the same as the other share classes. Fund size $47.7 million number of holdings, $699 total advisory fee, $145,078 and portfolio turnover, a high 201%. That high turnover rate is definitely noteworthy. And what about the fund's investments? US government and US government agency obligations are the largest chunk at 55.1%. Corporate bonds are next at 33%. US government agency mortgage securities are 16.2%. This also points to a diversified bond strategy, likely aiming for credit enhancement and yield beyond just treasuries. Let's move on to the Fidelity Short-Term Bond Index Fund. As an index fund aiming to track the Bloomberg US 1 to 5 year government credit bond index, its costs were minuscule, just $3 for $10,000 investment, or 0.03%. What affected the fund's performance this period? The key reason cited is the Federal Reserve's pivot to cutting interest rates from September through December 2024 and expectations of resumed cuts in September 2025. For a short-term bond fund, interest rate movements are a major factor. The report mentions the portfolio is constructed using optimization to minimize risk exposure differences compared to the index. The asset allocation is heavily skewed towards US government and US government agency obligations at a whopping 69.8%. Corporate bonds are at 28.3%. This high concentration in government debt is consistent with tracking a government bond index. Naturally, top holdings are dominated by US Treasury notes and bonds, making up 69.5% and 11.5% respectively. This confirms the fund's focus on US Treasuries. This fund is all about tracking a benchmark with minimal cost, which is a common strategy for investors seeking broad market exposure without active management fees. Now we're looking at the Fidelity Series Sustainable Investment Grade Bond Fund. This fund had zero fund costs for the last year, a point that stands out significantly. For a $10,000 investment, the cost was $0 or 0.00%. This definitely catches the eye. The performance drivers are again consistent with the broader bond market narrative. US taxable investment grade bonds posted a solid advance. Security selection contributed to outperformance versus the benchmark Bloomberg US Aggregate Bond Index. The report highlights corporate holdings in financials like REITs and banks as contributors, and also mentions an overweight in collateralized loan obligations as helpful. Underweights in mortgage Backed securities and US Treasuries also boosted relative performance. The investment mix shows a massive 69.3% in US government and US government agency obligations. This is very high. Then we have AAA rated at 15.6%, A rated at 23.8%, and BBB rated at 9.7%. The 27% in short term investments and net other assets liabilities is quite substantial and suggests a capital preservation focus. Then we have the Fidelity Conservative Income Bond Fund. For a $10,000 investment, the cost was $26 or 0.25%. The performance story here is aligned with the overall market narrative. US taxable investment grade bonds did well. The fund's strategy of holding short-term debt in high-quality corporations contributed to performance. Debt holdings among financial institutions, particularly banks and industrial firms, added value. Asset-backed securities also contributed. Looking at the last 10 years for this fund, a $10,000 investment grew to $12,685. That is a steady increase. The 1-year return is 4.82%, the 5-year return is 3.11%, and the 10-year return is 2.41%. This shows consistent, if not explosive growth, suggesting a conservative approach. Key fund statistics show a fund size of $7.6 billion with 345 holdings. The total advisory fee is high at $13.7 million, but given the fund size, it is about 1.7% of assets. Portfolio turnover is 73%, moderate for an actively managed bond fund. And what did the fund invest in? US government and US government agency obligations are at 18%, AAA rated are 15.6%, and AA rated are 4.4%. A rated is 23.8% and BBB rated is 9.7%. The most striking figure here is the 27.7% in short-term investments and net other assets liabilities. This confirms the fund's conservative approach, prioritizing liquidity and capital preservation. Let's break down the top holdings. US Treasury bills are the largest at 14.2%. US Treasury notes are at 3.8%. Then we see banks like Mitsubishi UFJ Trust and Banking Corp and Mizuho Bank Limited. Now this is interesting for a conservative income bond fund to have such a significant portion of foreign banks in its top holdings. It raises a question about the conservative aspect, although overall the fund's investments are high quality. Finally, we have the Fidelity Conservative Income Bond Fund Class Z. This is another share class likely for institutional investors. The cost for a $10,000 investment was $21 or 0.20%, again very low cost. The performance discussion is similar to other conservative funds, with US taxable investment grade bonds advancing and the fund's strategy of holding short-term debt in high-quality corporations contributing. However, the report mentions a roughly 13% average allocation to cash, which detracted from relative performance at times. Cumulative performance for this class from May 2023 to August 2025 shows a $10,000 investment growing to $10,762. The 1-year return is 4.77% and the life of fund return is 5.43%. These figures are competitive and suggest solid risk-adjusted returns. The key fund statistics are the same as the other classes of this fund. Fund size $7.6 billion, number of holdings $345 total advisory fee, $13.7 million and portfolio turnover 73%. The asset allocation is also the same with a notable 27.7% in short term investments. This confirms the fund's focus on conservative income generation and capital preservation. So what is the overall picture? We've seen a range of bond funds from Fidelity all reporting for August 2025. The market performance was generally positive for investment grade bonds, boosted by expectations of Fed rate cuts. The index funds are clear winners on cost. The Core Plus Bond Fund showed a strategic tilt towards high yield opportunities like high yield bonds and CLOs. The conservative income bond funds are prioritizing safety with large cash holdings and a focus on high quality debt. The series Corporate Bond Fund is heavily into corporate credit with a focus on BBB rated debt, which offers yield potential, but also higher risk. What is my take on all this? Fidelity continues to offer a wide spectrum of bond funds catering to different risk appetites and investment goals. The cost efficiency of index funds is undeniable. For actively managed funds like the Sustainable Core Plus Bond Fund, success hinges on smart security selection and strategic sector tilts. The conservative options are truly conservative, sticking to safety. However, the presence of foreign banks in the top holdings of a conservative fund does warrant a closer look for those who value extreme predictability in assets. The concentration in mortgage-backed securities for the SAI investment grade securitized fund is also a key point for risk assessment. Overall, it is a mixed bag of performance driver strategy choices and asset allocations across these funds. The bond market seems to be performing well, but investors should always understand the specific strategy and risks of each fund. What is your take on these Fidelity funds and their performance? Let me know your thoughts in the comments below. If you found this breakdown valuable, please give it a thumbs up and subscribe for more deep dives into the world of corporate finance and investments. And don't forget to join our Discord community linked in the description. Thanks for watching, and we'll see you in the next episode. Hey everyone, welcome back to Corporate Decoder, the place where we unpack the nitty-gritty of company reports and tell you what it all means. Today we're diving deep into a substantial SEC filing from Fidelity SALEM Street, Trust their certified shareholder report for the period ending the 31st of August 2025, and let me tell you, it is packed with numbers and details that tell quite a story about how these funds are performing. If you appreciate getting straight insights from corporate documents, make sure you are subscribed and hit that notification bell. We also have a fantastic community Discord linked in the description below where you can connect with other finance enthusiasts and get even more exclusive content. This report on Form N-CSR is a big one covering several different funds, but we're going to zero in on the financial story to see what is really going on. We'll be looking at their costs, how the funds performed, what affected that performance, and what exactly they're investing in. It is a lot of information, but we'll break it down so it is easy to understand. So what we're looking at is an annual shareholder report as of the 31st of August 2025. This isn't just one fund though, it is a whole family including the Fidelity Conservative Income Bond Fund, the Fidelity SCI Investment Grade Securitized Fund, the Fidelity SCI Sustainable Low Duration Bond Fund, and several others. It's a deep dive into their bond funds primarily. First up, let's talk about costs. Nobody likes paying high fees, and this report breaks it down for us. For a hypothetical $10,000 investment in the Fidelity Conservative Income Bond Fund, the cost paid was $26. That is a 0.25% of the investment. Lower costs generally mean more of your money is working for you, not just disappearing into fees. The Fidelity Advisor Conservative Income Bond Fund Class Z had even lower costs at $21 or 0.20%. That is a real saving. Now for the juicy part, what affected the fund's performance. For the 12 months ending the 31st of August 2025, US taxable investment grade bonds did pretty well. They navigated some uncertainty related to tariffs, and a resilient economy helped them along. Plus, the expectation of interest rate cuts by the US Federal Reserve in the latter half of 2025 gave them a boost. This is where the fund's strategy comes into play. For the Fidelity Conservative Income Bond Fund, its approach of holding short-term debt in high-quality corporations was a performance booster when compared to the all-US Treasury benchmark for the fiscal year. The report mentions that debt holdings within financial institutions, particularly banks and industrial firms, especially those in consumer cyclical and consumer non-cyclical segments, added notable value. This means they picked good companies that did well. Beyond just the benchmark companies, the fund also made non-benchmark investments in asset-backed securities, primarily car loan debt, and these contributed meaningfully to performance. This shows the fund managers were looking for opportunities outside of the standard indexes. However, it wasn't all good news. The report notes that the fund's strategy of holding short-term debt in high-quality corporations contributed to performance. But in contrast, the fund's yield curve positioning, meaning the mix of maturities, detracted from relative performance. This basically means their bets on when interest rates might change didn't quite pan out as expected. A roughly 13% average allocation to cash, which the fund maintained for liquidity and solid interest return, also detracted from relative performance. This large cash allocation is a sign of a very conservative investment approach. Looking at how the fund's investments changed over the year, we see a shift. Corporates made up about 48% of fund assets, down from roughly 60% a year ago. Exposure to US Treasuries rose from about 26% to roughly 30% of assets. At the same time, their position in asset-backed securities rose from about 11% to 19% as of the 31st of August. This suggests a move towards treasuries and a continued bet on their asset-backed securities strategies. Let's talk about how the fund performed over the past 10 years. For an initial investment of $10,000 in the Fidelity Conservative Income Bond Fund, it grew to $12,685 by August 2025. That is a steady and consistent growth. The 1-year return was 4.82%, the 5-year return was 3.11%, and the 10-year return was 2.41%. This long-term performance supports its objective of providing conservative income. It also notably outperformed the Bloomberg US Aggregate Bond Index over the last 10 years. Let's peek at some key fund statistics as of the 31st of August 2025. The fund size is substantial at $7.68 billion with 345 holdings. The total advisory fee is also quite high at $13.7 million, which translates to about 0.18% of the fund size. This advisory fee is on the higher side for a bond fund, suggesting active management strategies. The portfolio turnover rate is 73%, indicating a moderate level of trading. So what did the fund actually invest in? US government and US government agency obligations make up 18% of the net assets. Corporate bonds are the largest segment at 38.2%. Asset-backed securities are at 16.1%. This fund is quite diversified across different fixed income sectors. Looking at quality diversification, we see 15.6% in AAA rated securities, 4.4% in AA, and 23.8% in A-rated. The significant allocation to higher quality bonds aligns with a conservative strategy. However, there is also 9.7% in BBB rated bonds, which carry a bit more risk for potentially higher yield, alongside 27.7% in short-term investments and net other assets liabilities. This large cash allocation is a clear indicator of their conservative approach prioritizing capital preservation. Looking at the top holdings, US Treasury bills are the largest at 14.2%, followed by US Treasury notes at 3.8%. What is a bit surprising is to see foreign banks like Mitsubishi UFJ Trust and Banking Corp and Mizuho Bank Ltd in the top 10 holdings. While these are large institutions, their presence here might raise an eyebrow for a fund that is meant to be conservative and heavily invested in US assets. The top 10 holdings make up 29.2% of the fund, which is a moderate concentration. We're now looking at the Fidelity Series Corporate Bond Fund. This fund has an incredibly low expense ratio of 0.0%. That means no management fees for the investor, and the investment advisor covers other operating expenses. This is a major advantage for cost-conscious investors. What affected the fund's performance this period? The report highlights solid advances in US taxable investment-grade bonds. Security selection contributed to outperformance versus the Bloomberg US Credit Bond Index. Picks among industrial sector companies, specifically Warner Brothers Discovery Charter Communications and Boeing, were strong performers. Notably, financial issuers like banks, real estate investment trusts, and insurance companies also aided relative performance. The asset allocation here is heavily weighted towards corporate bonds at 83.2%. US Treasury obligations are a smaller piece at 10.1%. This fund is primarily focused on corporate credit. The quality diversification shows a significant portion in A-rated at 25.2% and BBB rated at 52.7%. This BBB allocation indicates a strategy that likely seeks higher yield by investing in bonds rated just above speculative grade. Top holdings are heavily dominated by corporate bonds. US Treasury bonds are present at 10.1%. Then we see large financial institutions like Bank of America, Morgan Stanley, and JP Morgan Chase. Industrials like Boeing and Broadcom are also in the mix. This top holdings list clearly reflects the fund's focus on corporate credit across various sectors. Finally, we have the Fidelity size sustainable low duration bond fund. The cost for a hypothetical $10,000 investment was $21 or 0.20%. This is a competitive expense ratio, especially for an actively managed fund. What affected the fund's performance this period? Again, the report mentions the solid advance of US taxable investment grade, bonds navigating tariff uncertainty and benefiting from stable inflation and expected Fed rate cuts. The fund's strategy of holding short-term debt in high-quality corporations alongside financial institutions and industrials added value. Asset-backed securities like car loan debt also contributed. The asset allocation reveals a large portion in corporate bonds at 44.9%. US Treasury obligations are also significant at 31.1%. Then we see asset-backed securities at 19%. This fund appears to have a balanced approach across corporate treasuries and asset-backed securities, aiming for sustainable income in a low duration strategy. Geographically, it is heavily concentrated in the United States at 85.8%, with Canada at 4.2% and the United Kingdom at 3.7%. Top holdings are firmly rooted in US Treasury bills and notes, comprising over 31% of the fund. Big financial names like Bank of America, JP Morgan Chase, and Goldman Sachs are also present. So what can we conclude from these Fidelity reports? Across-the-board performance in the reporting period was largely influenced by the positive momentum in US taxable investment-grade bonds and the anticipation of Fed rate cuts. The index funds continue to lead in cost efficiency. The Core Plus Bond Fund shows confidence in higher-yielding segments like high-yield bonds and close. The Conservative Income Bond Fund emphasizes capital preservation with substantial cash and treasury allocations. The series Corporate Bond Fund leans heavily into corporate credit with a focus on BBB-rated securities, a strategy that could offer yield but also carries more risk. And the Sustainable Low Duration Fund maintains a balanced approach across corporates, treasuries, and asset-backed securities. There is a lot to unpack here, but it is clear that Fidelity is offering a diverse range of bond funds, each with its own strategy risks and opportunities. The low costs for index funds are particularly attractive. For actively managed funds, the key stories are about where managers are finding yield and managing risk in a changing interest rate environment. What is your take on these Fidelity funds and their performance? Are you leaning towards the low-cost index options or the actively managed strategies? Let me know your thoughts in the comments below. If you found this breakdown valuable, please give it a thumbs up and subscribe for more deep dives into the world of corporate finance and investments. And don't forget to check out our Discord community linked in the description. Thanks for watching, and we'll see you in the next episode.